Okay, so let me go over a really simple example. I think we may have done this one a while back, but suppose we have, for example, a coin flip with a 50% chance of heads and a 50% chance of tails. And if the coin comes up heads, with the heads you'll receive $2, and at tails you will receive nothing. What would a risk-neutral minded person pay to play this game?
$1.
$1, and we're assuming no interest, right? It's not like you pay $1 now and then the coins flip a year from now and there's interest. So assuming no interest, you would pay $1. And the logic was because $1 equals, there's a 50% chance you'll get $2. We're going to figure out the expected payout of this coin flip plus a 50% chance you will receive $0. And that equals $1. So that's what you pay right now, and this has no interest involved. Okay. Now suppose we have another example. Example 2. We have a security that's currently selling for $2, and it may, if the market goes up, go to $4, and it may, if the market goes down, drop to $1. So this isn't like a real world security. A security that's currently selling, and now let's say this is 1 year later. So, you know what, this example won't have interest. So this could be an instant later, like a coin flip. So this is like, let's say, a stock that's currently selling for $2, and at some point in the near future, it's either going to be worth exactly $4 or exactly $1. There's no chance of $3 or $2 or $12. So it's some kind of like a weird market where there's only two possible outcomes. Now suppose somebody wanted to sell a call option with K equal to a strike price of, say, $2.
I'm
Yeah.
sorry, are there calculators in here?
Maybe, I don't know.
Oh, okay.
You could look around if you
Alright.
So the call option with a strike price of $2. So what does that mean? You get everything above $2. And again, this is going to be 0.5, 0.5, just like the coin toss from before. Okay. If we go to the upstate, how much money are you going to get if you buy the call option? The strike price is $2, so you get everything above $2, right? So how much would you get if we go into the upstate?
$2.
$2. If we go into the downstate, what does the call option pay?
Nothing.
0. It pays everything above $2 and the price is 1, so it pays nothing. So the payouts are going to be either $2 or $0. 50% chance you're going to get $2, 50% chance you're going to get $0. What would you pay for this option?
So $1.
So it's really, yeah, it's the same exact question with the coin flip before, it's just kind of all in disguise. It's a call option on a stock doing this, but the payouts are just like the coin. Heads was $2, tails was 0. So the price of this option,
That's just because it's an option though. Like if it was just the stock, you think a fair present value for that stock should have been $2.50 or so, right?
right. So that's actually, yeah, this does look a little strange. That's a good point. So let's see, the call option, the price of the call, let's see, would equal $1 right now. But it looks a little strange that if there's no interest between these two periods, you pay $2 today and you could either get $4 or $1. What's the expected return if you bought the stock would be the average of these two numbers, which would be $2.50. And with no interest, it would be, you'd be better off buying the stock. If you're a risk-neutral minded person, you'd be better off buying the stock than buying the option. well, if the option is priced fairly, the stock almost seems like it's not priced fairly. This should almost be $2.50.
Right.
And then the option of, with a strike price of $2 would still be $1. But yeah, so the more fair price here, since there's no interest, would be $2.50. Okay. So now let's do another, hopefully very simple example. Suppose you have, this will be example 3. Example 3A would be, the risk-free rate is 5%, and you want to receive $105 1 year from now. What would you pay today to receive, if you're going to receive $105 a year from today, and the interest rate is 5%, what would be the fair price to pay today to receive $105 a year from now? Hopefully that's an easy one. 100. We would pay $100 today if the free market rate was 105. Okay. Okay, then, now this would be just a bank paying it out. Now suppose question 3B says the interest rate is again 5%. You are receiving an expected payout. The expected value of the payout would be 105. Not necessarily going to be 105. In the first case, it's going to be exactly 105. You put the money in the bank, you'll get 105. It's guaranteed. Now you're investing in you're investing in something that may pay more than 105, less than 105, but the expected value is 105. What would the price for that be? Does the fact that it's not guaranteed to be 105, but just expected to be 105, cause the question to change to a risk-neutral minded person? No, as long as it's expected to return 105, you would pay today 100. Okay. Okay, so now let me do another example. Suppose we have a stock that's currently selling for $2.50. Stock that's currently selling for $2.50, and it could go. There's a 50% chance it could go to $4.20, and there's a 50% chance it could go to $1.05. And during this period of time, from time 0 to time 1, R is equal to, and let's say this was 1 year, R is equal to 5%. So this is a 1 year period. Okay. So you're going to pay something today, and then 1 year from now, after 5% of interest, you could get a payout of $4.20 or $1.05. Okay. What would be the price of a call option? What would a call at time 0 right now cost you? In other words, what would you pay right now to have a call option? Oh, let's say the call option, the strike price. Let's say we have a call option with a strike price of $2.10 and an expiration of 1 year. Okay, what would this call price be right now? So the strike is $2.10. So really, it's similar to the example I just did before, except I've tacked on interest, right? This is $4 plus 5% interest. This is $1 plus 5% interest. This number is a little odd, so it kind of throws off the whole martingale pricing thing. But what would you pay for a call option today with a strike price of $2.10? 1 year from today. So if the market goes into an up market, what would the payout be? If you bought the call option and the underlying stock was worth $4.20, what would the payout to you be? $2.10. So the payout to you would be $2.10. And if the stock price went down to 105 and the strike price is $2.10, what would your payout be? 0. Okay. So there's a 50% chance you're going to get $2.10 and a 50% chance you're going to get 0. So how much are you expected to get a year from now? You're expected to get $2.10 times 50% plus 0 times 50%. That's what you're expected to get a year from now. Doesn't mean you're definitely going to get that, but that's what you're expected to get. But then you want to subtract off interest. So how do we subtract off interest? We could just go like this, right? Divided by 1 plus r, which is 0.05. And so what would this equal? This would equal $1.05 plus 0 is $1.05. Divided by 1.05 equals $1. That makes sense? So really, it's kind of like I keep asking the same question over and over. This is the same question with interest tacked on. Forgetting about what this number is originally, 1 year from now, it's either going to be worth $4.20 or $1.05. So if we take the expected value of the option, the expected value of the option is going to be $1.05. There's a 50% chance it's going to be worth $2.10 and a 50% chance it's going to be worth 0. So I've said, what is this option I'm buying today? What is it expected to be worth a year from today? It's 50% chance it's $2.10 and 50% chance it's 0, so $1.05 is what it's expected to be worth a year from now. And there's an interest rate of 5%. So $1.05 a year from today is the same as $1 today. So you would pay $1 today would be the fair price for this option that has these probabilities and therefore these payouts. Okay, now staying with this example, let's see, 4B. Okay, suppose the interest rate, it'd be kind of nice to have this on the same page, but suppose the interest rate is 0.05 and K equals 0, the strike price is $0, what would the price of the option be now? So this is maybe this is a little bit of a trick question. You can have an option of strike, well, you would never see this in the real stock market, but if you had an option with a strike price of 0, what does that mean? How much, what is it worth a year from today? No, the strike price, I'm sorry, it's a call option with a strike price of 0. So you get everything above 0, which is what?
The price of the stock.
The price of the stock. It's a stupid option, right? So I mean, that's almost like a trick question. Like, how could an option with a strike price of 0? How could you replicate that buying and selling the stock? You would just buy one share, and that's the option. An option with a strike price of 0 is exactly the same as buying the stock. So what would that be? What would the price of that be? I'm saying, okay, with an interest rate of 5%, a strike price of 0, what would the option be worth? Right? You might start going like this. You might say, well, it could be worth $1.05 and it could be worth $4.20 with a 50% chance of each and average them out and all that. But this question actually would be whatever the price of the stock is today. That should match exactly. If there was a market issuing calls with a strike price of 0 and that price didn't match this number, there'd be an arbitrage. Because then you could buy the stock and replicate the stock with the option, and if they're different prices, you could be guaranteed to make money. So that kind of lets you know that this price couldn't really be right. This wouldn't really exist in the market. That's why I was saying this is kind of a goofy price for now. What would actually be the right price? The right price for the stock, assuming this was a risk-neutral market, would be you would take the average of these two numbers and then discount 5% interest, and that would be what should be here. Which would be what, by the way? $5.25 divided in half, and then discounted back. What would that be?
262, right? 263 would be the half.
Right. 262.5,
Right.
and then discounted back. What would that be? Maybe that is the right price then. What's 5% off? 262.5. Discounted back 5% would be 10. No, maybe it is the right price then, right?
Yeah, it says
Yeah.
250.
250. Okay, so then it is the right price. Okay, so then if we wanted to, so then what I was going to say, I was saying it was kind of a trick question. If this didn't calculate back to the correct price, the call price of an option that has a strike price of 0 should always be whatever the current price of the stock is. If it's not, there's an arbitrage. But that's one reason the markets don't offer those, is because you could just buy the stock. Why would they offer you something that's exactly the same as buying the stock? It's only opening the door to an arbitrage price happening. Okay. Now, suppose we wanted to, for C, suppose we wanted to have, we have an interest rate of, again, 0.05, and we have a strike price of $2.10, and now we're doing a put. What would the price of a put be? Okay. So the strike is 210, kind of like what we had before, except it's not a call, it's now a put. So what does a put mean? We get $1 for everything below 210. So what would that be worth? How do we calculate that? Well, there's a 50% chance. The price of the put would be, there's a 50% chance we're going to, the market will go up and we'll get nothing, right? If the market goes up, we get everything below $2.10 for a put. So if it goes up to $4.20, we get nothing. If it goes down to $1.05, we get what? We get $1.05. We get everything below $2.10. So we would get 50% chance we're gonna get nothing, plus a 50% chance we're going to get $1.05. And then we have to discount this back to today's dollars. So what would this be? This would be, we could say this is gone, and these two cancel, and we get 50 cents. We get 50 cents. So the put option would cost 50 cents today. And let's just say, what would the corresponding call be for the same price? We said that before. That was what? The call was $1. Okay. So the call was $1 and the corresponding put was 50 cents. Okay. It make sense so far? Or? Okay. Now suppose we wanted to go a step further and build a chart for call and put prices. And let's say duration. Duration is all 1 year. Okay, so suppose we said that the call price, we said the call price for a stock that had a strike price of 0, even though that wouldn't exist in the real world, we'll just start from 0 and go to infinity. The call price was $2.50. What would the price of a put be? You get everything below 0. What would a person be willing to pay for that?
$2.50.
No, so whatever the price is a year from now, you collect, for every dollar below 0, you get money. How much money are you gonna get?
0.
You're not gonna get anything, so what would you pay to have the opportunity
0.
to get 0? Right, okay. So you would pay 0 today. And then if the strike price was 1.05, $1.05, what would people pay? For a put, you get everything below 105. What would you pay for that opportunity? You pay 0 again. You would pay 0 for a put if the strike price was 105. What would you pay for a call? A call says you get everything above 105. So if the price hits 105, you'll get 0. And if the price hits 420, you'll get what? You'll get 315, half of 315 discounted back would be $3 cut in half, discounted back would be $1.50. That sound right?
Kind of, but it's already selling at $2.50, so you can just flip it real quick.
No, wait, we're talking, we have a call. So what I want to, this is what I want to do. I want to fill in this chart. I'll do, and you'll see something interesting. $3.15. $4.20, and then some number above $4.20, I'll say $5.25. So I'm basically starting it, I'm looking at all the strike prices, and I wanna see any relationship between the put and the calls. Okay, so I wanna fill in this chart. And just see anything interesting, a relationship between the call and put prices. But, so, for a strike price of $1.05, a put, you get everything below $1.05, so you wouldn't pay anything for that. For a strike, you would get, for a call, you would get everything above $1.05. So if we go to the low state, you get nothing. And if it goes to the upper state, you'll get $3.15 would be a payout for a call option with a strike price of $1.05. So, what would you pay for that? It would be $3.15 discounted back, take 5% off, which would be $3, and then cut in half, right? Half the time you'll get $3.15, half the time you'll get nothing, and then you have to take away the 15 cents for the discount. So that would end up being $1.50. So that would be $1.50. Now, if the strike price was $2.10, if the strike price was $2.10, what would you pay for a put? Half the time you'll get nothing, and half the time you'll get $1.05 discounted back. So half the time you get $1, half the time you get nothing. So that would be 50 cents. That make sense? You would pay 50 cents for a put. Actually, we just calculated that on this screen. That was this one. Okay, and what would you pay for the corresponding call? What would you pay for a call with a strike price of $2.10?
$1.
Would it be $1? Let's see. With a strike price of $2.10, you get everything above $2.10. Oh, we did that one. Yeah. Okay. All right. That would be $1. Okay. Now with a strike price of $3.15.
75, the call or the put?
Let's do both.
I'm gonna say $1 for the put and 75 cents for the call. I don't know.
$1 for the put. So let's see, we get, this is for $3.15. For the put, we get everything below $3.15, which would be $2.10 in a down market and nothing in an up market. So $2.10 discounted back is $2, and you get that half the time. So that would be $1. Is that what you said? $1?
Yeah.
Okay. You said $1.75?
Yeah, but I could be wrong. I could want to change my call to
Right.
to 50 cents.
So this was, what did we say, this was $1?
Yeah.
Okay. Yeah, we're starting to notice a pattern that, what do you know, are you ready to solve the puzzle? What's the pattern? So wait, let's go, there's a pattern when we're between these two prices, there's something the call and the put price have to do with each other. Okay, so wait, for $3.15, the call, half the time we get 0 and half the time we get $1.05. Discounted back would be $1 and then cut in half, because we only get it half the time, would be 50 cents. So this would be 50 cents. So wait, you said 75 here?
But then I changed it.
Oh, okay. What made you think 75? Does any?
Because I saw you went from $1 change and then 50-cent change, so then I was thinking 25-cent change.
Oh, okay.
But then I changed it because I was like, oh, it's gonna go down another 50 cents.
Okay. And then for a strike price of $4.20, what would you pay for a call? You get everything above $4.20. It'll never go above that, so you pay nothing. For a put with a strike price of $4.20, you get everything below $4.20. So you get nothing up here, and you'll get $3.15 if it goes into the downstate. Discounted back would be $3, and you get that half the time, so that would be $1.50. that would be $1.50 for the put and 0 for the call. A call with a strike price of $4.20, you'll never get above $4.20, so why would you pay for it? But you would pay $1.50 today for a put, because half the time you'll make $3.15, and half the time you'll make nothing. Take away the 15 cents for interest, half the time you get $1.50 in today's money, and half the time you get nothing. No, sorry, half the time you get $3 in today's money, and half the time you get nothing, so you'd pay $1.50 today. And then what if it went up to $5.20, and obviously $5.20 and anything thereafter would take on a different pattern. If the strike price was $5.20, what would you pay for a call? You get everything above $5.20. It's never gonna go there, so that would be 0. But for a put, you get everything below $5.20. Sorry, $5.25. Half the time you get $1.05, and half the time you'll get $4.20. And you'd wanna average those two. That would be $5.25, subtract interest, cut in half would be $2.50. So this is 0, and this is now $2.50. If we're between, if we're in this area, the price of the call and the put together always was $1.50. The total, 0 plus $1.50, 50 plus $1, $1 plus 50, $1.50 plus $1. This was always P0 plus C0 always equaled $1.50. Outside of that range, then it started growing. One of them would always equal 0, and the other one would start growing as the range, as the strike price grew outside of this range. As the strike price grew outside of this range, so does the put of the call, the corresponding put of the call. But in the meantime, we could pay $1.50, and for any of the points, and this would also be true for any other point. If we picked any other point between $1.05 and $4.20, if we picked any strike price, the total of the call and the put would be $1.50. I just picked, ones that made the math very easy, but I could have picked any one, and that would have been the call price. I'm sorry, the call and the put together would be $1.50. So what do you get when you buy a call and a put for the same stock price? You get a payout for whatever that strike price is, how far away you got from it. Right? If you actually nail the strike price, you get nothing on both sides. Right? So if you bought a put and a call at, say, $2.10, and then a year later the price was exactly $2.10, you wouldn't get paid for either one. So you're actually looking for how far away you are from the strike price will be how much money you get. So then, based on this data, how far you're expected to be away from any one of those strike prices would be $1.50, because that's what you're paying. You're paying $1.50. You're hoping to get a return of actually $1.50 plus interest. So that would be like $1.57.5. And that's what you expect on average for any one of these strike prices. On average, you expect to be that far away from it. Okay. Now we'll talk about this topic called elementary securities. So suppose we have a market that looks like this now. We have two securities. And if the market goes up, the first security, so we have now two securities, and this is now realize we can make this vector as big as every security that's in the stock market. So we have two securities. One is currently selling for $1. If the market goes up, it remains at $1. And the second security, which is currently selling for $1, if the market goes up, it starts selling for $2. If the market goes down, the first security continues to sell at $1, and the second one sells at 50 cents. Okay. So does this example make sense? I know you probably, this isn't in our textbook. But what we're really saying is this: we have two stocks, and the market is like, maybe the market has good news or the market has bad news. And one stock seems to apparently be unaffected by the news. It seems to be staying $1 no matter what happens. This other one either gets better or gets worse. Right? So let's say this is a stock that will either double or cut in half, and the other stock stays the same no matter what the market does. Okay. Suppose these are the only two stocks in the world, and you wanted to invest a certain amount of money into the stock market, so that if the market does good, you'll get $8, and if the market does bad, you'll get $3. Let's say you decide, depending on what state the market's in, I've determined what payouts I need. Maybe you're managing a portfolio and you need to hedge, so you need these certain payouts. Is there any way we could do this? Any idea off the top of your head how we could approach this? Like, well, actually, let me do this. We could certainly buy a certain amount of the first security and a certain amount of the second security, right? And then time passes and our value either goes up or down, right? So let's say we were to buy theta 1 of the first security and theta 2 units of the second security. How much money would we have later on? So here's time 0, and here's time 1. If at time 0 we bought theta 1 units of the first security and theta 2 units of the second security, how much would we have if the market went up? We'd have one of these and two times this. That's how much money we would have, right? If the market went down, we'd have 1 times this plus a half times this. So, yeah, let me do an example. So suppose we had theta 1 equals 3 and theta 2 equals 2. So we bought 3 units of this thing and 2 units of the second one. So in the up state, we would have 3 times 1 plus 2 times 2 equals $7. If these were dollars. If we, no, sorry, these are units, these are dollars. Let me get rid of that. This is 3 units and 2 units. And this is currently $1, it goes to $1. $1 becomes $2. So, if we bought 3 of these and 2 of those, and the market went up, we would end up having a net worth of $7. If the market went down, we would end up with 3 times 1 plus 2 times 0.5 equals $4. So that's all it's saying. There's nothing too fancy going on. There's just 2 different stocks, and if the market goes up, they have the values change to these numbers, and if the market goes down, the values change to these numbers. We have an opportunity to come along and buy as many units of each of these, right? You could take 2 shares of IBM and 4 shares of something else, and then time passes, and you look at the new prices plus the number of shares you have, and you see what your net worth is. So we actually started out with how much? We started out with $5, and we'd end up with either 7 or 4 at some point in the future, if the market behaved exactly like this. So what we can do is, and I'll just rewrite this. 1, 1 goes to 1, 2, 4, 1.5. So that's the market. Market could either go up or down. And we're allowed to buy, let's say, theta 1 units of the first one, and theta 2 units of the second one. So suppose we did this. Theta 1 units of the first one. Okay, now suppose we wanted to do this. Suppose we wanted to say, how much money should we invest? How much money should we invest? So if the market, I want to make an investment right now, so that if the market goes up, I receive $1, and if the market goes down, I receive $0. That sounds strange, but then we're going to use this as a building block. Suppose we could figure out a way to buy a combination of these two securities, so that if the market goes up, we receive $1, and if the market goes down, we receive 0. That would be a good building block, because now if we decided if the market goes up, I want to receive $8, I'll just buy 8 of those things. Right? If we could figure out a way. So how could we figure out a way to say, I want to start off with a certain amount of money, like a derivative, a combination of these two, something that derives its value from these two stocks, but has the property that if the market goes up, I receive $1, and if the market goes down, I receive nothing. So how can we do that? So if we say, how much money are we going to have if the market goes up? We're going to have theta 1 plus 2 times theta 2. We want that to equal $1. So what we're trying to do is we're trying to figure out, we want to buy so many units of the first thing and so many units of the second thing, so that if the market goes up, we get $1, and if the market goes down, we get $0. And then let's figure out what theta 1 and theta 2 are. There's going to be a little linear algebra here. So theta 1 plus a half of theta 2, we want to receive $0. And if we could come up with this, then we can buy as many of these units as we want. So we do some linear algebra, what do we get? We want to figure out what theta 1 and theta 2 is. So if we subtract these two lines, we would get 1.5 theta 2 equals 1 minus 0 equals 1, right? And then theta 2 equals 1 divided by 1.5 equals 0.667. And therefore, theta 1, does this ring a bell like from linear algebra? Solving simultaneous equation?
Kinda, not like, I mean, that was like the beginning of linear algebra.
Right. Actually, we could throw this into a matrix and, okay, but what would theta 1 be? So if theta 2 is 2/3, then 2 times 2/3, what's the easier line to use? 2/3 times a half. All right, 2 times 2/3 is 1 1/3. So this would have to equal what? This plus 1 1/3 equals 1.
Negative a third.
Negative a third. Now, what we're really doing here is we're buying negative 1/3 units of the first security, and we're buying 2/3 units of the second security. How can we buy negative securities? We know that trick. That's just either shorting the stock or borrowing the stock and selling it, turning it to cash, and then repaying the cash later. You can buy negative shares of a security, right? Okay, so how much money do we lay out right now to get a security that pays $1 in the upstate and 0 in the lower state? We would pay, the price right now would be theta 1 plus theta 2 equals negative 0.333 plus 0.667 equals 1/3. So it'll be 33 cents, or 1/3 of a dollar. So for 1/3 of a dollar, now we'd have to spend the money in a strange way. We would actually be borrowing the first security and converting it to cash and using that to buy the second security. So we take 33 cents out of our pocket, plus the 33 cents we gained by borrowing the first security. Put that 67 cents together, buy the second security, and 1 year later, our net worth will either be $1 if the market goes up or 0 if the market goes down. And we could do a similar thing for the other way. The other way would be theta 1 plus 2 theta 2 equals 0, and theta 1 plus a half theta 2 equals 1. We want to also have a security that if the market goes down, we get $1, and if the market goes up, we get 0. Now, if we had both of those, and they're each going to cause some little fee, like 33 cents. If we then later wanted to say, if the market goes up, I want $4, and if the market goes down, I want $12, we just buy 4 of the first one and 12 of the second one, and figure out what the price is. And now we can just sit back and whatever the market does, we'll get the payout we want. So how would we get this one? This is again, what would we do here? 1.5 theta 2, I'm subtracting, equals -1. So theta 2 equals -1 over 1.5, which is -0.667. That's how many units of theta 2 we would buy. Therefore, theta 1 in this case would be, I'll use this line, -2/3, that's -1 1/3, added to this equals 0. So that would have to be +1 1/3. We'd have to buy 1 1/3 units of the first security and then buy -2/3 units of the second security. So we would lay out, we would pay theta 1 plus theta 2 equals 1.333 plus -0.667 equals 0.667. So the cost of a security, taking this market, so this is now a market, it's 2 different stocks. And we want to figure out a way that says if the market goes up, I get $1, if the market goes down, I get 0. That'll cost us 33 cents for every unit of that we want to buy. And we'd also like to know if the market goes down, I get $1, and if the market goes up, I get 0. And we know that costs 2/3 of a dollar per unit of those. So those are more expensive. The one where if the market goes down, I gain $1, and if the market goes up, I get nothing. So now, suppose we decided, we're managing a big fund, and we decided that we want a payout of, let's say, if upmarket, if there's an upmarket, then we get, anyway, pick a number, doesn't really matter.
5.
5. So we want $5 if the market goes up, and then if the down market, we get what? So let's say we've done a bunch of investments, and then we're worried if the market goes down, we're going to lose a ton of money, so we want to hedge. We want to make a final bet to kind of cancel that out. If the market goes down, let's say we need to get, I don't know, pick any number.
3?
$3. Okay, we need $3. Can we buy an investment that if the market goes up, I get $5, and if the market goes down, I get $3? And the answer is, yeah. We could look at these elementary securities. For 33 cents, I can buy something that if the market goes up, I get $1, and if the market goes down, I get nothing. So I'll buy 5 units of those. And then if the market goes down, I get $1, and the market goes up, I get 0. That cost me 67 cents each. I'll buy 3 units of those. So now I can just buy 5 times 33 cents plus 3 times 0.667 equals, so I can pay today, no, these aren't good numbers, right? Wait.
Isn't there a negative in there? Or no?
For which one?
The 33.3.
All right, well, first of all, could there ever be a negative? This is like a good side comment. Could a what do we call this, elementary securities, could the price of an elementary security, so remember, an elementary security is basically defined like this. If, of all the states the market can go to, and I'm using a simple example, there's 2 states, but we could have like 8 states if we want. An elementary security pays you $1 in one state and 0 in all other states. So then you can just buy as many of those units you need, depending on what state you care about. You get to say, oh, if it goes into this state, I need $8. So you would just buy 8 of those units. So an elementary security, you pay some fee now, and when time is up, you'll either get $1 for a specific state or 0 for all other states. So could it ever be negative? Could the price of it ever be negative? If there was, that'd be an arbitrage, right? Because if the price was negative, that means you receive money now, and in the future you're either going to get 0 or you might even get more money, and that would be an arbitrage. So it should always be a positive number. If you come out with a negative number, then you know you made a math error. So now, so what were the prices? It was 2/3 for the bottom one and 1/3 for the top one. So this would now be 1/3 of 5, so it's 5 over 3 plus 6 over 3 equals 11 over 3, which is $3.67. So we could pay $3.67 right now and get the payout that you wanted. This arbitrary payout that was just kind of made. For $3.67 right now, you can get a payout